Money Show.
Personal Finance with Warren Ingram.
Right, time for personal finance now with Warren Ingram. He's the personal financial advisor and executive director at Galileo Capital. Tonight we talk about playing the long game, setting up an investment strategy that will help you grow your investments without falling for quick gain schemes that could have you gambling your investment portfolio. Warren joins us now. Welcome again, Warren, for the personal finance feature. How do we make sure that we start a strategy for our share portfolio?
I think it's so tempting to kind of chase the bright shiny object that's coming across our screens, across our social media feeds, listening to our friends and on WhatsApp groups, etc. When people start bragging about the investment that they've just made has doubled in the last 3 days or 3 months, and especially things that start to get a bit of attention in the media. I think. The things that are really doing well now, that are brand new and kind of new technology, or especially new fashions or new themes in the investment world, to me are always things that you should kind of stop and take stock of it and think about before you just jump in and follow because that's what everyone else is doing. So maybe the first piece of advice is stop and think, stop and look and stop and maybe do some homework. I'm not saying avoid all new investments or avoid all new themes or new technologies, etc. But I think just be careful of a fad or a fashion, because I think we saw that, we've got some great examples of that in the last two years. When the world went into hard lockdown, all of a sudden we started to see these, they call them the meme stocks and the Robin Hood shares that especially in the States, just started to, kind of grow right through the roof. Absolutely, you saw kind of 100% or 200% returns in periods of days and weeks. And all of a sudden, you had these people going on social media and challenging, investment gurus like Warren Buffett and saying, I'm 18 years old and I know how the investment world works. You're too old. You don't know what you're doing. And I'm going to show you how this is done now, Gramps, and over and above the disrespect shown to someone who's made billions for people around the world. History shows us that those meme stocks absolutely imploded, and a lot of the kind of newfangled stuff that was developed turned out to be absolute hot air and hype, and funny to watch Warren Buffett's company Berkshire Hathaway delivering fantastic returns month after month when the world seems to be falling apart.
And that's that
so
long game, Warren, isn't it? That's the long game you're talking about. But how does someone make sure, that they match their personality to their share trading strategy? You're talking about Warren Buffett, who's more cautious and who's willing to wait. And there's some people who have a bigger risk appetite and are willing to, risk it now to gain now. So how do you make sure that you match your strategy with your personality as an investor?
I think I know people are going to say I'm old fashioned, but I think there is nothing that you can buy that's going to make you lots of money in a very short space of time. Nothing reliable. If you want to, be certain of making a lot of money in a short period of time, you're going to need to either get extremely lucky, which means start gambling, and I certainly don't want to gamble my money away because I think the odds are heavily stacked against me. Or you're going to need to find yourself a life partner that's way richer than you are and get hitched. Beyond those two strategies, the only way that you can be sure of making money on a consistent and sustained basis is you have to take a long-term view. You have to kind of throw that short-term thinking right out the window, because the things that go up go up a lot in a short space of time almost always go down again. And I think that's the thing we need to realize is we need to throw FOMO out the window. We can't get jealous of what's going on around us. When we see things that have just doubled, I'm just thinking, I'm not knocking the crypto world, but if you just look at the crypto world, when you see cryptos, going up, doubling and doubling again, and it's easy to be tempted by those returns and to think, I should just put some money in here just in case I miss out. Well, $60,000 down to $20,000 is the ride I'm really happy to miss out on. And I'm really happy that, that some people have made money out of it, and I'm not jealous at all, because I'd much rather own a good basket of shares, either ones that I've chosen myself or just in an index or just a share-based unit trust, and let that compound itself month after month, year after year. And it will be rocky sometimes. I mean, we all know what the stock market's doing right now.
Yeah.
But watch the space. Watch what the stock market does over decades. It has been proven time and time again to be your very best place to get long-term real growth. In other words, growth that's way better than inflation. And you don't need to chase the shiny new objects, and you don't need to be an expert on cryptography or whatever it's going to be next week, whatever the new fashion is. You can ignore all of that stuff. So maybe that's my advice, is take a long-term view. Don't be afraid to kind of sound boring because you buy baskets of shares or indexes, because those are the things that really deliver growth over long periods of time. And Warren Buffett is a master at taking risk. He's the opposite of being conservative. He is a massive risk taker. He invests tens of billions of dollars buying entire companies. But one thing he's got that a lot of us don't have, and I'll put myself in that category, he's got incredible patience and the fortitude to ignore what's going on. And I think, those are important things.
And how do we focus on the patience of the dividends that we get paid? And how do we make sure that we have the patience to reinvest them? Because, of course, we could be tempted in saying, look, I've invested and I think it's time I have a bit of some of my efforts. How do we make sure that we have the patience to reinvest in order to get better compound earnings later on?
I love that you're talking about dividends, because it's the silent assassin of the investment world. So just to understand the stock market, if you look at the growth of the stock market over long periods of time, half of that growth that you get from the stock market are the dividends that are generated by the listed companies that you own, and those dividends need to be reinvested. So if you really want to make your money make lots of money babies, what you need to do is make sure that you are earning dividends and that you are reinvesting those dividends every single time you get them. And I'm not saying that you can't enjoy your money from time to time, and enjoy the fruits of your labors and the fruits of the growth that you're generating. But just understand that rather let the dividends be reinvested and do it automatically, do it in a really disciplined way. And then from time to time, you can draw some capital out, to fund whatever expense you want, or I always say rather set aside a little bit of your monthly income for fun, for rewarding yourself for working hard and those kinds of things. But always make sure that you've paid yourself first. In other words, you've put some money away and you've allowed your capital to keep growing. And the secret is time. The secret is kind of not tracking your investments on a regular basis. Let those dividends be generated and be reinvested. And then, look at your investments every 6 or 12 months. Don't track them every day, because what happens on a day-to-day basis is absolute noise. It's certainly not a trend or a direction or anything you can do with it. And then, the one best tip I can give anybody is you're not going to find the next best investment on social media. Your friends on WhatsApp groups and whatever social media feed you've got, they're not the ones that are going to tell you where the investment returns are going to be made. That's going to come from proper research, proper thinking, listening to the Money Show, and that's where you get the information. It's not, some 19-year-old that left school like 6 weeks ago and is now an investment guru, unfortunately.
Yeah, listen to Warren Ingram on the Money Show, of course. But how do you, avoid that panic and block the noise? The guys in the office kitchen telling you they've made 2,000 Rand in 2 days, and how do you make sure you stick to your strategy? What are some of the signs that you look at even when some of the companies you've invested in are dropping in terms of shares?
So I think there may be two parts to that. One will be if you've bought, let's just say you've bought shares and you've bought a good basket or good handful of high quality businesses, and they're down now. The one thing you should do is try and understand why they've gone down. In other words, has the whole stock market gone down and your companies have simply gone down alongside the market? Because if that's the case, then close your statement and don't worry about it. Ignore everyone that's talking around the kitchen at the office, because what's happening is a normal market cycle. This is what stock markets do. They go up fast, they go down fast, but over time, the ups definitely outweigh the downs. So then you can just forget about it. And if you've got some spare cash, try and invest a bit more when the market's down, because that's the great opportunity. But if you've bought some newfangled thing that a whole lot of other people have bought and it's now collapsed, and you don't know exactly why it's gone down, and and certainly it's not down in relation to a broader market, then perhaps you've bought a dud. And perhaps it's time to sell and forget about what everyone else is telling you, and don't try and, they talk about trade the dips, don't try and trade this thing and say, well, I'll buy in again, when it falls a bit more and I'm sure I'll make my money back. Because if you don't understand what you bought in the first place, then surely you won't understand why it will rise again. And that's something you need to just avoid altogether. So I think it's about understanding why things have gone down and then saying, okay, I'm comfortable that if I own a whole basket of shares that include Microsoft and Amazon and those kinds of companies, BMW and Daimler Chrysler, all sorts of things that sell real stuff to real people, that things that will be used for the next few years or decades. Well, Microsoft will still be around next year. It doesn't matter that share price is down. In fact, they'll probably make a lot of money.
Well, that's Warren Ingram telling you to sit on your hands when you have an investment strategy and assess the market before selling any of your investments. And that's, of course, playing the long game. Is our personal finance feature with Warren Ingram. Don't gamble your investments. We'll pick up this conversation in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Back with your personal finance conversation with Warren Ingram. Of course, he's telling us not to gamble with our investments. Now, Warren, I once heard a horror story. One of my friends was moving jobs and he, withdrew some of his pension. And after withdrawing it, he thought he could invest it in cryptocurrencies. Now, of course, that money is gone. How do we make sure that we pick the right money from our budgets, from our livelihoods, to make sure that we trade shares with them instead of, getting money from riskier places like our pensions?
That's such a devastating story that gets repeated in our country so often. I just wish our government would ban, the ability for people to withdraw all of their pensions. It's such wealth destruction. So let's just talk it through. What happens there is you cash in let's say you've got 100,000 Rand in your company provident fund and you resign. So now you're going to pay tax on that withdrawal. It's going to be, so that whole amount gets added to your taxable income for the year. And so, let's say you were paying 25% tax before, suddenly you're adding 100,000 Rand to your taxable income. So you might end up in a tax rate in that year of 30 or, 32% or something. So your 100,000 Rand that you were banking on is now worth only 70,000 Rand. Then you take that 70,000 Rand and you go ahead and put it in cryptos and the 70 becomes 2. And that's a permanent loss of capital. That's wealth destruction on a grand scale. That money will just never be recovered. So I think, lesson number one for me is, unless you're kind of in a position, and I'm trying not to exaggerate, but unless you're in a position where you kind of can't eat or you don't have a place to live, you should try everything you possibly can to never cash in your retirement fund if you're changing jobs. And certainly, please don't quit your job simply because you want to access your retirement fund so you can invest in cryptocurrencies. That's just really, real wealth destruction on a grand scale, because the chances of getting another job are also not that great. So, and unfortunately, that's not an exaggeration. That's what people do. And it's just really not a good idea. So the money that you invest in high growth assets, and to me, that means, buying shares, and the like. That's money that you should be investing on a monthly basis. It's money that you should be prepared will be invested for at least 5 to 10 years, where you don't need to access that money for some kind of an unforeseen emergency. So my first comment, I guess, is make sure you've got an emergency fund that covers any unforeseen expenses in the next 3 to 6 months, and then invest the money that you can afford to leave for at least 5 years, and ideally 10. I'm not saying it needs to be locked away in some kind of a fixed contract or something, but don't plan to say, well, I'm going to invest the money now and I know I'll be able to get a lot more money in 6 months' time. That might not be the case. You might be in the middle of a stock market crash in 6 months' time, and you need to leave the money there to ride out those big rocky times.
We often talk about a good basket of shares, in terms of your portfolio, but what's a good breakup in terms of diversifying? Which industries should you be looking at? Which industries can you pair with the other to make sure that, if one falls, this one is likely to be strong? I
think the first thing is look at, try and get exposure to as many different industries as possible, as opposed to let's say one or two. So those in big sectors of the market, whether you go through kind of the pharmaceuticals, that make the drugs that we all need, and I'm talking about legal drugs, of course, or you add then hospitals, you add things that companies that actually make things, industrial businesses, you add mining houses, banks, insurance companies. So try and get a big spread. Either it's kind of one from each of those sectors, or, alternatively just buy an index that covers all of the market at once, because then, you've got a proper spread of assets in that one investment. So it's making sure that you've got a really good diversification. Don't simply go and buy only tech shares, for example, because, if we see what's happened to the tech sector, all of the tech shares are down, at the same time, the good ones and the bad ones.
And here's a question from one of our listeners. They're saying, I'm not sure if this is the correct platform to ask this question. Definitely is with the Money Show. I am 53 and have just sold the family home post-divorce. I've received the proceeds, which went into my current account. I've moved the bulk of it, which is about 1 million rand, into a money market at Standard Bank. And the other 500,000 I've moved into a Quantum Plus account. Now, I have no pension, do not need to buy another house, so would like advice on whether I should be putting the money into a higher risk category, and what is that, or just put it into a fixed deposit, or look at another financial business that would give me at least 6% interest earnings after 5 years tax-free. So what would be your advice on that one? I know it's a very complicated one. There's a lot of options there, but what would you advise?
So let's go for the principles. I think the first thing is, having a portion of your money available in cash, so putting money into money market account, I think is a very smart thing to do. But make sure you don't have too much cash. So for me, the ideal amount of cash for people is somewhere around 6 months worth of their normal expenses. So if you're spending 10,000 Rand a month, then make sure you've got 60,000 Rand a month, 60,000, as a total in your money market account that you can call on at any time if something goes wrong. And to me, that's the ideal amount of cash. Some people might be really risk averse, and in which case maybe go for 12 months worth of expenses. But I don't think you should go for more than that. Then putting the rest of your money into something like a fixed deposit, or an account that only gives you 6% interest after 5 years, even if it's tax free. I think you need to know, about the slow poison called inflation, because inflation, for the last few decades has been around about 6%. I know, sometimes it's been lower and right now it's higher. But when you're getting investments that are only giving you around 6%, what you need to realize is your money's not really beating inflation. It's probably actually going backwards. So what that means is in 2 or 3 years' time, the buying power of your money is actually worth less than what it was today. So you need to have exposure, at least with some of that money, to the stock market, which will give you that inflation protection. And to do something really simple, like buy a balanced unit trust, that has a good exposure to shares. It also has exposure to cash and to bonds and to property companies, and it will have some international exposure as well. So if you don't know what to do, a good balanced fund is often the best idea for people who just want to do something decent and sensible with their money. But certainly I wouldn't be putting it into something that only generates interest, because unfortunately interest, earns tax as well. So once you take tax and inflation off your interest, what you realize is 5 or 10 years time, your buying power is probably going to be half of what it is today. And that's really no good at all.
And that's advice worth a fortune, of course, for our caller there and a listener who put in a question and got some sound advice from Warren Ingram, personal financial advisor and executive director at Galileo Capital, in tonight's Personal Finance, talking about not gambling your investments and going with the strategy that works.